So the valuation range is an important criteria. Lina, what questions?
The willingness to follow up on grounds.
Okay, so this is, so what is she referring? So for instance, when, I'm sorry? Okay, so we have, so what we do is you have the valuation, you have two different things here. One is the deep pockets of your value. So this person, deep pockets means that he's willing, he's funding you, but in 2 years down the road, you know that you're going to have a few more galleries. You need to have somebody who is funding you. So is this investor willing to follow with me? Is he willing to come up and invest in the future? If he says, this is the only amount that I have and I won't follow you, for you it's less interesting. Why? Because you'll have to go through the process and go and find other investors. So the deep pockets, hence the willingness, not only willingness, the willingness / ability to follow on future rounds. This is quite important. So what you do is you want to have somebody who has the money, but is willing, because you know that you're going to have one round, another round, a third round, because this is part of your transformation plan, and you prefer to work with one that is willing to follow you. What other, Ziad, what would you add to this list? So the alignment in your case, yes?
I want introductions and relationships in the...
Okay, so he wants introduction, industry exposure. In his view, is the network. He wants people to open doors. So from his perspective, it's the alignment in values, probably also alignment in the direction. He doesn't want to have to argue and justify his strategic direction every time. And he wants somebody who could be able to open doors. So this is, yes?
The process and the reporting requirements.
Okay. Okay, so what is this point? Reporting requirements.
Micro versus micromanagement.
Okay, so this is a good point. So reporting requirements, you would have, if I use the example of Sami, I mean, we've been working on this fund. So for each of the companies that we finance, we ask them on a quarterly basis, this is what we expect from you. This is the information that we expect. We have agreed on a certain project that you have to do. So these are the key achievements. We agree what are the problems that you are facing, what is the support that you need, and then we look at your financials. So there is a minimum set of requirements. Now, others might have 10 pages or 20 pages worth of requirement. So it's a very administrative, heavy reporting. So what you want is a reporting requirement is there, but it is the how heavy is this reporting requirement is. If it's very heavy, it means that you will probably have to appoint someone full-time. All this person does is basically get the data together and submit the data to the board or to the investors behind it. You know, if it's light investments requirement, it's much easier. So the reporting requirement is one factor that will have an impact on your resources. What else?
Sometimes it's just simple character compatibility.
Okay, so the character, I'll put it under the values. I will put here so you have the character fit. It's quite important. So character fit normally goes in terms of the value. Do we have, yes, Marie-Michel?
We want the investor to believe in our product.
Yes.
To have faith,
Yes.
to have trust.
Yes. It is, you're right here, which is what I call the alignment in the strategic direction and in the strategic priorities. So this person is aligned. He knows where you're going. He supports you where you go. We are aligned, so he doesn't feel that, no, you should start with the US itself, starting with the Middle East. No, you should not diversify your portfolio. Focus on your heart monitoring. Don't get into other products. So this alignment is quite important, because if there is no alignment there, it's going to be continuous, convincing, pulling, stretching, and this is very, very painful. Yes?
Isn't one of the criteria the size of the investor? Because a very minority investor is not going to get
Okay,
involved in those.
so I will put it in more general terms. I will say the brand of the investor. What happened, brand of investor. If you are, for instance, getting a business angel, so Raja decided to invest 50K or 100K in your company. Raja is a great person, he has this. But if it's a venture capital company that is the leading one that decides to invest, the brand, nothing against Raja, it could be Constantin. So what we have, so the brand of the investor is important because this will carry weight. You know, one of the potential investor that Ziad is looking is an established person that has been leading one of the largest organizations in the US and is well known in the market, well respected. So the stronger is the brand of your investor, the more people would say, wow, he has managed to convince this person to be an investor. This then it means that this person went through the due diligence and felt it. So the brand of the investor is important. And how do you measure the brand? You have different companies, and some companies are very well known. You know, so if you have in the banking sector or the VC sector, you have a list, you will have certain categories. So this is quite important. Any final one before I leave the floor to, yes?
Duration of the investment, and they need liquidity, dividends per year, income per year, or they're looking for long-term growth?
Okay, so what you have here, this is normally in the term sheet. I'm going to have this is basically the alignments on all the different alignments on term sheets. The term sheet will say it's 5 years or it's 7 years. The term sheet would say we're going to exit with these conditions. The term sheet is going to tell you if you have certain requirements. So you need to align, because if the term sheet, you have two different views, ما راح تمشي العملية. So the term sheet is a good one. So these are a number of the criteria. Now what you need to do as a company owner is you take this list and you prioritize it. What is the one that is important for you? What is the one that's less important for you? And then what we do is you meet 1, 2, 3, 4 potential investors, and you rank these investors along these dimensions. And then what you do is you present this to the board. So this process is a very important process in raising capital and in finding the right investors. Is rank, put your selection criteria. Prioritize these selection criteria. Not only you, also the other shareholders. Then meet with different companies and rank them around these selection criteria that you have selected. This takes time. It takes time not to put the list together, but it takes time to meet with the different companies and to validate. How do you know about their track record? You know, you need to ask them, how many have they exited? You know, what sort of return they got on the exit? This process is a very important process in the equity raising. It's the deciding on who are the right investors on it. Any questions on this? Okay, the number, this is another question. I will answer it. What I'm going to do, because both Sami, قد ايش ساعة سامي؟ لا عن جد إلا ربع تعرف في بعد ربع ساعة. So I'm going to ask Sami, both of you to come at the same time. That's true? لا تعال. Sami, Ziad and Sami, I'm going to ask both of you. So I had the pleasure and the honor to work with both gentlemen. So Ziad is the founder of Cardio Diagnostics. He had already 2 rounds of funding. He might be getting to a 3rd round of funding. In his first round of funding, Sami invested. So this was presented in the investment committee, part of Beritech Fund 1. So you have 2 perspectives with 2 different views on it. So what I'm going to do is I'm going to ask with Ziad. So and I'll ask the same question to Sami. So now you have different phases in terms of the equity raising. So one of the phases that you have in here, we looked at the criteria and we looked at the valuation methodology. And the other phase, once you agree on a valuation, is how do you agree on the term sheet? From your perspective, what are the 2 or 3 things that you felt were positive in terms of the experience? What are the 2 or 3 things that now, with the 5 years back, you would have done differently?
Sure. So starting back in 2012, 5 years ago, when we interacted with Veritech Fund, we felt a supportive environment. We felt that there is a true belief in the mission of establishing innovations and technology companies in Lebanon. So I felt that was a very strong emotional tie that brought us closer to Veritech Fund. The valuation at the time was acceptable for what was available at the market rate. Today the dynamics are different, so each time comes with its own value or zone. I personally like the interaction with the people, so I like Sami on a personal level. I think we get along well personally. Looking back in time, I probably, if I had the luxury of choosing people from my industry or who know the heart of my industry, I would have done that. But looking back at what was available in 2012, I don't think that was an opportunity.
Okay, so in your case, what you say is the fit is quite important. The other thing that you would have preferred is to get the sector expertise, which was important, but at the time, probably money was very little available, so you took what was available behind it. So the sector expertise is something that you, and now, for instance, in the future rounds, this becomes a key element. So if you're looking at the future investor, this industry exposure, sector expertise, the ability to network will be high on your lists?
Absolutely. So I've made a commitment to myself. I'm not taking any money from outside the clear added value beyond the dollar sign. So if I ever want to take money, I want to make sure that this money comes with the clear added value in terms of expanding the potential, the prospect of the company, its geographic or its product lines, or its availability, or reinforcing the brand. So that's very important for us in the coming phase.
Okay. Sami, same question. From the investment perspective, what do you think are the things that worked well? What do you think are the things that you would have done differently?
Well, as a fund, we had a certain amount of money that we needed to invest. And I got in touch with Ziad, and I looked at his business plan, and I liked what I saw. And I like Ziad as a person, even though I didn't know him before, but he has a good feel about him as a young entrepreneur, creative with new ideas in a very important field. And he had a mission in his life that to save life in the cardiac field, because his father died of a heart attack, and had he had his product before, his father would still be alive today. So I like the fact that he has a clear mission in mind, and he's passionate about what he was doing.
Mm. So this is actually a very important point that you put here. This passion from both the investor side and from the company side is critical. So if this passion is here, the other thing that was mentioned is the social impact. So in his mind, it was not, we didn't have social enterprise at the time, but what he looked at it, he's looked because he's saving lives. So if this works, tens of thousands of lives could be saved through this. I'm actually, I forgot, I want to test it. Yeah, so it is so free for so we have, no, we want to test it.
Guys, Cardio Diagnostics, look us up online. We can give you discounted monitoring.
No, but what they do is the usual monitoring is about 1 day or 2 days, and I tried it. It's very bulky. What is the name of the product that you?
The Holter.
The Holter. So you have a Holter. You take it for 1 day on it. You put the patch here. You have the small device that you put in your pocket, and you keep it for 1 month completely. So what you do is you have the tracking over a 1 month period. It's cloud-based, so you have a much higher quality of data being available. So. How do you shower? Can you shower with...
So some of the patches are actually waterproof. And we have a number of stories of actual patients whose lives were transformed or even saved because of the technology.
Because of the technology. So this is quite... So I'm going back to the criteria. So social impact was important at the time. The passion that he had was important in terms of the... and there was the fit and belief that there is really a growth potential behind it. Things that you would have done differently in the negotiation or in the valuation or the term sheet negotiation?
The valuation, let me touch a bit on the valuation in general. Valuation is a term that we always use without putting it into perspective. Valuation is a curve. I would like to call it a curve valuation. Depend at what stage of growth the company is. So at the mature stage of a company, valuation is a science. There are analysts who are cracking numbers, who have got models, computer models that were worked out in business schools for many years, and it was validated. So if a company wants to go public, or if a company wants to merge, those guys, they sit down and they crack the number and they come down with a proper value for the company on a scientific basis. So at this stage, valuation is a science. Now, if I am an investor and I want today to invest in a listed company, very quickly I can look at the PE ratio, that the price to earning ratio of that company, compare it to other similar company, and then I can decide, yes, this company is fairly valued, overvalued, or undervalued. So this is again a science. Now, if we go along the curve, and the company is less mature, and it is in a growth stage, and it doesn't have profits yet. So I would look at it from a different point of view. I would look at it, how much of a market share it has, how much it has got in sales, what is the price related to sale rather than price related to earning, because as the company is growing, they need to spend as much money as possible to grow. Therefore, the bottom line is going to suffer. They're not going to show a profit. They're going to show a loss for a longer period until they get to the next stage. Now, if a company hasn't got yet to the sales level, I would look at the number of users and the growth of the number of users. Those users on the internet, most of them is free. So we did not monetize them yet, but they are growing. So this would be a criteria that I would use. And then moving along the curve, the company is a startup. It doesn't have sales, it doesn't have customers, it doesn't have users. So how do I value this company? So it moves from science to
Art.
art. Now, here, the art side of it is the personal feel of the investor about the potential of that company and who is behind that company. It is the founder. So I am putting a lot of weight then on the founder and whether he is a one-man show or it is a team. And I am really valuing that person. So if I have a belief that that person has got the capability of building a business and growing it, this is what I am investing in. So it is a matter then of negotiation between me and the founder, how much I'm willing to pay and how much he is willing to accept. And this is what happened with Ziad. When we invested in Cardio Diagnostic, it was just a very startup, and we put a value at the time of above $1 million. I mean, why would you pay $1 million for just something in the air? So it's really a dream. So, and then 5 years down the line, a new investor comes in and he says, now it's not anymore a dream. Let's look at reality now. What have you achieved in those 5 years? How much did your company grow? How fast it grew at? Because the faster the rate of growth, the more value the company will have. So this is more or less about valuation in general.
Yeah.
What's intuition? Intuition has something to do with it.
Intuition, in my opinion, as you gain experience in life and you are acquiring knowledge and experiences, those are transferred by your brain into intuitions. So when you say I have a gut feeling, actually it's not a gut feeling. It is your brain who is analyzing all the past experiences and coming up, yes, go for it.
When you value, you have different ways. I'm going to share it. I'm going to explain it. You have books behind it. You have different. We have different, and I will share these methodologies. The first methodology is a very simple one. So if we look at, let's look at Ziad's company. The first methodology is called asset-based valuation. What is asset-based valuation? If I take cardio diagnostics, if you remember in the previous meeting that we had, is we had on one side, we had all the assets. What are the assets of the company? It's the cash that they hold in their bank accounts. It is the receivables that they have because they have some payment terms to their customers. They might have some stock that they have inventory, or they might have some property, plant, and equipment. Okay, so we have, I forgot your first name. Michel. So Michel, for instance, work for Technica. So we have, and they produce assembly lines for FMCG companies, and they distribute those across the region and across the world. So he has a number, or the company has a number of assets. They also hold inventory. They also have receivables because they offer payment terms 30 days, 60 days. What are your payment terms to your customers typically?
Depends on the customer.
But the range is 30 to 90 days? 30 to 90 days on the head. So this will be like they act as a bank with it. Now against this, they might have some debt and they might have some suppliers that they need to pay. The difference between the assets and the liabilities is what we call shareholder equity. Shareholder equity is the book value. So if I have to put at one point in time, what is the value of Technica, what is the value of cardiodiagnostics, I could take the shareholder equity, which is called as the accounting value, as the base of the value. So this is one way, which is it. But I will take it and I will adjust it. I will adjust it because cardiodiagnostic have built the brand. I would adjust it because there is going to be some future revenue growth that are not reflected. So this adjustment, I will give it a premium, but this is the most conservative valuation, is you take your balance sheet of the previous year, you look at your total assets, you look at your total liabilities. The difference between the two is the shareholder value or the net book value or the accounting value. And this gives the accounting value of any enterprises. Now, this doesn't apply to enterprises. I use my case. I file for income taxes. I do it in Switzerland, but if I do it in the US, it would be the same. They ask me how much revenue I made. They ask me what sort of expenses I have, and they come up with a certain they call a taxable income. But they also ask me what are the assets that I have, houses, apartments, lands, car. I have to list them and I have to give a certain value. They ask me what are the total liabilities if I have debts that I used, and then they come up with a net asset value. And they tax me on this net asset value. So what applies to a company applies also to an individual. So I pay taxes based on a value, and they define what the value that Constantin has. So they will look at total assets, they will look at total liabilities, and they will say, this is your value, Constantin, today. So what applies to a company, so this is one way. The one way is net assets or asset-based valuation. Do you agree what it is? Are there questions behind it? Yes?
But does this work for a seed startup? Because the assets are...
Very good point. So for instance, when I sit down with seed startups, you don't have any assets. So what do I do? And I sat down with a number of you. I say, okay, how long has this company been in existence? Answer me. About 1 year. Okay, how many people worked on this already? 2? 20 people? 20, I'm sorry.
20 employees.
20 employees. So these 20 employees, in terms of average salary, what do you think is annual salary of these employees? Let's say $1,000. So this is already 20. 1,000 multiplied by 12 is $12,000. Multiplied by 20 is let's say $300,000 or $400,000. So this, for me, what I'm trying to do is I'm trying to look at the amounts of investments that took place already. You don't have assets, but you have time that you have spent. So you have the time. Have you developed anything? Have you developed a software, a package? What did they do? So this package has a certain value. So I would look at the amount of time that has been spent. I would look at the concrete deliverable that you have that we could market behind. And this will be, for me, the closest to an asset-based valuation. It's the most conservative valuation that we have. So do you understand the approach? So in this case, I would look at your past investments. I would look at the deliverables that you have. And based on this, I will come up with a valuation range. Okay, is this clear? Yes?
How I know that the past investment is the right investment?
It's a good question.
1 year, but this product needs 6 months.
Okay, it's a good, so what you typically will do is you will validate. So what did these people do? Okay, what was the output that came in? So you spend the same, for instance, in your case. When we first met, you said, look, this is my franchising model. I've developed this franchising model. I found the right location. I was able to come up with a business plan. I know how, all these things were investment that you have done. So I would look at the quality of your business plan. I will give it a value, $50,000, $100,000. It has a value. You've done your market research. You've done some focus group. You ask customers. All this for me is an indication that work has been done to validate it. it. From my previous experience, I will get a sense of what will be this value. So the work that you have done in coming to this point, in getting your franchising, convincing them that you're the right partner, you have invested already maybe in premises, you've invested already in putting together the first store. All these things are real investment that you have made either in time or in kind investments, and this will give me a net asset value. Is this clear? Yes, Zakiye.
The payroll is an asset or a liability?
Okay, the payroll actually is neither an asset nor a liability. The payroll is operating expenses. So when you do your income statement, the payroll will be, this is the amount of expenses that he had to pay on this thing. So normally, hopefully, if this is a good investment, we would look at in terms of intellectual, so he has, let's say, developed a mobile app. This mobile app would have a certain value. So normally, I would try to assess the value of it. So this payroll, which is an operating expense as part of an income statement, will end up into a value that could be actually capitalized. Because if this can be sold to a number of customers, it has a certain value. In software companies, what we will do is we'll say, okay, you have now the software package. We know that this software package, a number of R&D people, research and development people have worked. We will give it a value. So instead of expensing it, like paying salaries, we will then capitalize it, i.e. we will say he has spent 300,000. Out of the 300,000, we believe that 200,000 is actually the value of his mobile app. So on his income statement, we'll only show 120,000. And then on the balance sheet, I will show an IP for 200,000. Okay, so this could be way in terms of accounting. So it is an operating expense, but this could be reflected into an asset if we have a concrete deliverable that could be used elsewhere. And this will help us validate. So this asset-based valuation is the, I look at Tilian, she's half asleep now. She's saying, no, it's all right. She's my cousin, so I could tease her. It's all right. So it's, all right. So this is the first one. It's a very simple one. So if I take the example of Roger, I will say, Roger, list me. So you will say, this is the land that I own. This is the apartment that I own. These are the cars that I own. This will be my banking accounts that I have. We'll sit down together. I would have a whole list of what are his total assets. Now I look at the liabilities. Did you borrow? He will say, these are the debts that I have. This is, at the end, it's a very simple exercise. After half an hour, I know what his net book value is. I know what is the asset value that he has, that he's, now he's a US citizen. So as a US citizen, you have to declare everything. So no matter where you are, and even if you're in Timbuktu, you still have to pay taxes. They will follow you behind. But this is the asset-based valuation. It is the most conservative valuation. Now, why is it conservative? Why is the valuation that we have stated as asset-based is conservative? Okay, so it's basically history. It looks back at where I am at a period of time, and it says, these are my assets, these are liabilities at a period. It has no indication whatsoever in terms of the future. So in terms of the future, so for instance, if you're here and you know that your revenue is going to grow quite fast, this is not reflected into your valuation. So this is reflected, so it takes only a static view of what the value of the company is. Okay, so this is why, this is one of the reasons. The other reason, it doesn't take into consideration the brand. So for instance, if each one of you have a brand, and some people are looking at developing your brand. I use Rula. Rula has a dental things. People come to her because of her track record. They know her. She has a number of customers. These customers refer to other customers. Now, she would say she makes a certain income. She has a certain asset, certain liabilities. But what is not reflected is the fact that she, over the past 20 years, she has built a reputation. And because of this reputation, she could even overcharge compared to others, that new entrers that are coming in. The value of the brand is not reflected into the net asset value. So you need also to include it, because you have taken a brand that you have developed the brand, and the brand had to do with the quality of the services, had to do with, so this brand has a value, and this value could be maybe even greater than the difference between your assets and your liabilities. So this brand is quite, and a number of you says, okay, what do I need to do to protect my brand and to help my brand grow? So this is also part of valuation. Are you with me? So the most conservative thing is I list all my assets. The assets are very easily measured, very easily. sit down with you, I would do it. You know, I've done it already 35 times in my life for my own personal account. It's very straightforward. For companies, it's exactly the same. What are the liabilities? The difference in the net asset value. On top of this, I would add specific things like brand. On top of this, I will add specific things like, for instance, beside the brand IP. So if I have developed a patent, if I have developed a platform, if I have developed a mobile app, this has a certain value that is not reflected on my balance sheet. And these are the adjustments, and then I come up with a certain figure. Okay? Net assets adjusted. So this is the asset-based valuation. Yes?
Value the brand, you look at present revenue or you forecast for the future?
Okay, now brand valuation is a very difficult exercise. We have gone through it. The way you measure the brand, I use always the same example, and some of you have heard this example before. I have two sons. One son is very brand conscious. So it's the same T-shirt, like you have your T-shirt, same quality T-shirt. One is brandless, the other one has a brand. The difference is one could be at $5, same quality, and the other one is probably at $50. How do you measure the brand? Is that for the same quality of T-shirt, my youngest son is willing to pay $50. My eldest son doesn't give a damn. So he has the premium that you are charging multiplied by how much of these shirts you are selling gives you the value of the brand. So when you buy your Apple computer and you know that there could be a similar computer but it's sold at 20%, 30% less and you're willing to pay these 30% more, multiplied by the number of Apple computers sold, project this over 5 years, discount it back, it gives you the value of the Apple brand, the value of the Pepsi brand, the value of a Coke brand, the value of a Google. So all these things, the brand depends. The stronger the brand is, the stronger is your possibility to price with a premium. The higher is the premium, the higher is the value of the brand for similar sort of product. Now you have companies that specializes in helping you assess what is the value of the brand. They do this, and you have every year, you have a report of the value of the brand. What are the most valuable brand? And what is the most valuable brand today? What is? It's not Coco, it's not Google, it's Apple, it's still Apple. So what's interesting to see that the value of the Apple brand is in the range of $200 to $300 billion. So it's significantly higher than the net book value. So if you look at the Apple annual report, you look at the total assets, you look at the total liabilities, the difference between the two is probably 25 billion or 30 billion. When you look at the value of the brand, it's 10 times the difference between their asset and their liabilities. So the brand could have a huge impact on the value that you have.